The price cycle is the basic sort of representation of what it looks like to move price from A to B. So when price reaches an oversold area, and this could be an area of demand, what they're doing is they're accumulating orders, right? They're accumulating long positions, buy positions in order to drive price higher. So when price reaches an oversold area, you tend to see a trading range. You tend to see price, it would accumulate, and then the composite man will drive price higher once demand is higher than supply. Then you get the markup. And when price reaches a level of resistance, which is a level of supply, then that's where you get a distribution area. This is where prices are overbought, there's too much supply. And so when supply becomes greater than demand, price drops, right? This is called a markdown. And so when you look at price, you see this, it's fractal. When price is oversold, there's an accumulation at demand, and then there's a markup when demand is greater than supply. And when price reaches a level of resistance, where it's overbought, there's too much supply, you get a distribution occurring. And distribution is essentially where supply becomes greater than demand. And so the composite man is the one actually driving this cycle, this price cycle. And I guess the majority of the market is wrong. I guess they get it wrong. You know, when price is oversold, this is where retail are selling, right? So where retail are selling, or the uninformed investor, they are selling, the composite man is accumulating. And when it's the peak of the rally, when everybody is long, everyone's buying, the composite man looking to take profits. They're looking to distribute. They're distributing all of their orders. The ones that they accumulated here and here, they are now distributing them to all of the retail and uninformed investors who believe that price is going to go higher. This is what happens, right?